Good morning and welcome to our Green Up TV. I'm really happy to be with you today for the November edition of our monthly broadcasting. Today, we'll dive with our expert guest into labeled transition finance with the recent publication of new market guidance. But before that, as usual, let's start with our highlight of the month. On November 12, Bpifrance priced its inaugural European defense bond benchmark with a new €1 billion 5-year bond. This issuance marks Bpifrance's first under its newly established general framework for bond issuances in the European defense sector that was published in July 2025 and structured by Natixis team, which also acted as joint book runner. The mechanics of the bond are inspired from the use of proceeds approach of sustainability bonds without making any equivalent claim. The bond proceeds are allocated to specific defense assets, linking eligibility criteria, traceability, and allocation reporting. Our second news today in Brussels. On November 13, the European Parliament adopted its negotiating position on the so-called Omnibus package, amending the CSRD and the Corporate Sustainability Due Diligence Directive, the CS3D. After earlier turbulence in October, members of European Parliament finally approved a text based on a right and far-right alliance. So, under the Parliament's position, two things. The scope of CSRD will be substantially narrowed. Company will fall within the reporting obligation if it has more than 107,050 employees on average and a net turnover at least €550 million. This could represent a reduction of up to 92% of firms. The second one, on the CS3D, will undergo a complete deletion of requirements for climate transition plans. Civil liability obligation under CS3D will no longer be harmonized at EU level. They will be left to national law. So while this vote is a key milestone, as it confirms at least that a significant reduction of the CSRD scope is expected, it's not the end of the road. The Parliament now has its position to negotiate with the EU Council and the Commission in the so-called trilogue negotiations that will determine the final shape of the omnibus amendments to CSRD and CS3D. So final decision by the end of year on omnibus can now be expected. Last news, of course, the COP30 conference held in Belém, Brazil, has concluded after 2 weeks of discussions and negotiations. Referred to as the COP of implementation, adaptation, forest, people and truth. The event achieved some progress in certain areas while falling short in others. Let's see. NDCs. So by the end of COP30, 120 updated climate action plans, so the NDCs, were submitted, leaving 70 still outstanding. And the current NDCs place the world on a trajectory of 2.5 degrees, indicating a lack of increased ambition. To convert pledges in tangible actions, the Belém package introduced 2 key implementation mechanisms. The first one is the Global Implementation Accelerator. It's a voluntary initiative designed to prioritize actions that have the potential to scale mitigation and adaptation efforts. This includes addressing methane emissions, expanding renewable energy, improving battery technology, reducing the cost of capital, advancing digitalization, and reforming multilateral banks. The second one is the Belém Mission to 1.5, which aims to enhance ambition and foster international cooperation in mitigation, adaptation, and financing efforts. Adaptation. A significant commitment was made to triple adaptation finance by 2035, amounting to $120 billion per year as part of a broader target of $300 billion in overall climate finance. So while this commitment is a positive step in terms of amount, the extension of the deadline from 2030 to 2035 has been viewed as a setback. Progress was also made toward the Global Goal on Adaptation, the GCA, with the adaptation of 59 indicators to monitor progress, including indicators for tracking the implementation in finance, technology, capacity building, and one focused on gender-responsive adaptation policies. On fossil fuels and just transition. The goal of phasing out fossil fuels proved elusive, as the final text did not mention fossil fuels. Although there was no consensus on establishing a roadmap for transitioning away from fossil fuels, the Brazilian presidency announced the development of a fossil fuel roadmap independent of the negotiation. Regarding just transition, COP30 established the Belém mechanism to enhance international cooperation, technical assistance, capacity building, and knowledge sharing on that topic. Now, when it comes to climate finance, a 2-year program on climate finance was launched to enhance the predictability of public resources from both developed and developing countries, facilitating the discussions on the implementation of the Baku commitment. So the Baku to Belém roadmap highlighted the need for $1.3 trillion per year by 2035 to support developing countries. And now on international trade. So the text reaffirms that unilateral trade measures should not discriminate arbitrarily. For example, the carbon border adjustment mechanism, so the CBAM, and the deforestation-free import rules. 3 dialogues are scheduled to be held at subsidiary boards and to be reported back at the 2028 high-level event. So while the final agreements recognize that the global transition toward low greenhouse gas emission and climate resilient development is irreversible and the trend of the future, there is still a gap between intention and implementation. Now let's go to our figure of the month, 12%. This is the percentage of emission reduction that current NDCs will achieve by 2035 compared with the 2019 levels. This figure is below the 35% needed to align to a 2-degree pathway, or even the 55% needed if you want to align with a 1.5 degree pathway compared to a 2019 level by 2035. So it means that 2.3 to 2.5 degree of warming is expected by the end of the century if all emissions cutting plans are fully implemented by 2035. Now, let's move to our topic of the day, transition finance new guidance. On October 16, the LMA, APLMA, and LSTA published its guide to transition loans. On November 16, just after, ICMA published its climate transition bond guidelines. According to the G20 Sustainable Finance Working Group, transition finance is defined as financial services supporting whole-of-economy transitions toward lower and net zero emission and climate resilience in a way that is aligned with the goals of the Paris Agreement and the 2030 Agenda for Sustainable Development, and that considers as well the national circumstances. The question of whether a transition label is needed to enhance the financing of the real economy transition is not binary and has been highly debated in both LMA and ICMA bodies. The IEA recently published its Scaling Up Transition Finance report, which emphasized that for transition finance to deliver meaningful results globally, it needs to be deployed in specific sectors where emissions are hard to abate and in emerging and developing economies. And it should be tailored to local and technological circumstances as well as to issuer profiles. So with relevant conditions and safeguards, transition finance can move from being seen as a second tier of green finance to serving really as a second pillar of global financing for emission reduction, especially in sectors where emissions are hard to abate and emerging economies. So today, transition finance flows remain relatively modest, but scenarios consistent with national or global emission reduction targets suggest that between $400 and $500 billion per year in transition finance could be mobilized over the next decade, so an equivalent to between $4 and $5 trillion cumulatively. This is the comparables in scale with the current global green bond market, so we really need this complementary transition finance market. Transition finance is dynamic per nature, shaped by the diversity of national energy pathway, the fact that the type of investment needed evolve over time, and the necessity of considering the pace of transition and the length of transformation. All of this means that transition finance faces complex definitional challenges and needs robust safeguards to preserve integrity while limiting the room for interpretation. This is what we will just discuss now with our expert session. We are happy to welcome Orith, our head of Natixis Green and Sustainable Hub. She will share with us her testimony and her expert insight on these newly published transition guidelines from the LMA, LPLMA, and LSTA on one side for the loan market, and from the ICMA on the other side from the bond market. Welcome, Orith.
Thank you very much.
Can we start with the beginning? Can you please help us understand the transition finance context in which this guidance has been published? And what is the underlying intention?
Well, you've set the key elements of the context. The decarbonization of global economy needs hard-to-abate sectors to deeply decarbonize themselves. And as you rightly described earlier in the highlights of the month, the publication of the COP30 admittedly disappointing final agreement is very symptomatic of the sequence we are collectively witnessing. Geopolitics, sovereignty, energy security, defense, AI are shaping the international relations and cooperation. Climate is not forgotten. It is one in many alarming matters, not the very emergency mobilizing nations and multilateralism anymore. As we have discussed in previous editions of the Green Hub TV, headwinds to the environmental transition range from geopolitical to intrinsic industrial bottlenecks. Since early 2024, some regions face very strong headwinds and are experiencing all shades of these backlash. Between backtrack, withdrawal of some initiatives, lightening, as we see with the EU Omnibus, postponing, shift of decarbonization targets over time, or breaks, just like green projects at a standstill, while other regions keep on moving. Many of the key transition value chains, such as EV value chains, which are essential for establishing avenues of sovereignty, are facing challenges. They require effective public-private initiatives and policies, and they can create and safeguard the condition necessary for the financial viability as well as their growth and international competitiveness within stable and predictable regulatory environment. It is also obvious that private markets have a major role to play. In other words, we must explore all possible ways to attract more capital to finance the transition. Emerging economies are facing the urgency to decarbonize their highly carbon-intensive energy sectors and hard-to-abate industries, have been instrumental in mobilizing the sustainable loan and bond market participants to complete their funding tools with transition finance instruments that would recognize a reality we all know for a long time. Green and transition are two complementary legs of a common ambition, should we hope to keep Paris Agreement long-term targets at sight. In other words, reminding ourselves that underlying these long-term goals lies an absolute carbon budget in. And decarbonizing hard-to-abate sectors is what I would call a key absolute play, i.e. a necessary component to reach the necessary contraction of the carbon cake, not second tier to green technology, but next to them. Sustainable finance has historically addressed the topic of transition at entity level, with the sustainability-linked mechanisms introducing financial incentive mechanism towards material transition-related KPIs and ambitious science-based targets, as well as the Climate Transition Finance Handbook from ICMA on entity level for issuers seeking to use green bonds, sustainability-linked bonds, and sustainability bonds, or climate transition bonds, towards the achievement of their climate transition strategy. These two new guidances further elaborate on some of the key assets and projects instrumental to support these ambitions. These new guidances, to my opinion, set the foundations for additional labeled use of proceeds instruments to precisely address the financing needs from hard-to-abate industries, decarbonation, while attempting to properly frame them and frame the key consideration and safeguards to be mindful of when assessing such investments and financings.
So can you please summarize for us this new guidance? What are the key components? Is there any nuances or difference between the loan and the bond markets that you've seen?
Yeah, as you can see on the chart, the transition instruments are just fitting into the existing landscape of sustainable finance instruments. They are at the crossroad of use of proceeds and sustainability linked. They are dedicated to finance entities and/or projects for achieving the goals of the Paris Agreement, especially those from high-emitting industries, or hard-to-abate sectors, as I just mentioned. What those two guidances are reminding is that transition finance can be done at entity level and/or asset level, but in any case, they are fitting into an overall transition strategy. On the entity level, we are looking at financing dedicated projects or activity that are contributing to the decarbonation, which are on a credible pathway towards net zero emissions. And on the sustainability-linked general purpose, for which the financing is tied to achieving predefined decarbonation and GHG emission reduction objectives.
And in terms of nuances, maybe the common component and the nuances between both?
Well, when it comes to the common components and nuance between bonds and loans, I think there is one very clear answer. There's a very high level of consistency between the transition loans and the transition bond guidances. Very high level reference to the Paris Agreement as the umbrella ambition to be kept at sight and make explicit reference to science. Both recognize the complementarity between green and transition to finance the transition. Both recognize the necessary consideration for regional and sector-specific contexts and refer to existing frameworks and pathways such as local sustainable finance taxonomies. Both recognize the relevance of both entity-level instruments, sustainability-linked, and use of proceeds instruments to finance transition, and remind the key structuring blocks of transition-related SLLs or SLBs. Both create a standalone label for use of proceeds transition finance instrument. Both recognize for this new label the need to ensure that the contemplated assets or projects fit into a wider transition strategy at issuer or borrower level, ideally with a sound and robust transition plan. Both laid out key consideration to address when defining eligibility. Both have applied a similar governance and structure to transition use of proceeds instrument as historically with green use of proceeds instruments. Use of proceeds, process for evaluation and selection, management of proceeds, reporting. And both introduce a noticeable new type of eligible expenditure, phase out decommissioning of high emitting assets. There are a few nuances, I have to say, that would probably speak to the experts. LMA has introduced a fifth pillar in the very structure of the instrument, entity-level transition strategy, while the same very notion is positioned as a safeguard by the ICMA to be addressed in a comply or explain fashion. Explicit in the form of an exposure draft by the LMA, APLMA and LSTA, of a transition loan, use of proceeds loan principles, while ICMA keeps option open with a set of guidelines. Those are the main nuances I would name. And the last one, and probably most visible one is ICMA has gone one step further in laying out the highly debated, non-exhaustive list of examples of transition projects to make the guidance concrete, actionable, and make sure everybody understands what we are talking about. They're shown on screen. By no means it is an exhaustive list of projects. They are to be looked at in conjunction with the safeguards that have been set, namely the main safeguards that have been set: substantial GHG emission reduction, absence of low carbon alternative, limitation of carbon lock-in, science-based standard and pathways to be used. Those are the common safeguards between the two guidances. And then LMA has added a do no significant harm approach on two other environmental and social objectives, a notion that the LMA put as part of its management of the project selection process, which is a very equivalent approach. So to be looked at within those safeguards, and I would say that there was one additional difference in the ICMA production, which is dedicated safeguards when it comes to specific fossil fuel related activities. So without getting into more details, we're talking about CCUS and removal technologies applied to fossil fuel-based energy or industrial application, retirement, I have to precise early retirement, and decommissioning of high-emitting assets. We're looking at coal-fired plants, power plants, for example, fossil fuel switch. We're thinking of examples such as low carbon, coal to gas, switch. We're looking at lower carbon fuels. Definition yet to be I would say explicited, or topics like methane abatement and flaring.
So, to your opinion, why are these guidance useful, and what are the benefits, and especially to whom are they useful?
So, I believe that there are five main, I would say, advantages or rationale behind that additional label instrument. The main and the most obvious one is that it is going to facilitate sustainable finance market access for hard-to-abate sector, including fossil fuel players. B, it will enhance transition planning credibility and visibility with more transparency and consistency from issuers and borrowers. 3, it allows tackling transition accounting for geographical and sector specificities, which was very much awaited. It's also providing investors and financiers with what I would call a reassuring market-led framing of transition asset financing, including transition-enabling technologies. And more generally, it's providing the market with a more holistic set of well-framed instruments to address all necessary dimensions of transition, be it the green or the transition element.
And as active participant, at Natixis in both LMA and ICMA forums, we know that some topics were highly debated and discussed with the different members. Can you please, before hosting our guests, just share with us the few discussion points?
Well, keeping some room for the upcoming debate, I'm just going to tease a few of those key discussion points and recognized challenges in both forums, both the loan forum and the bond forum. Standalone label for transition use of proceeds, yes, no? Integration of entity-level transition plan and strategy, and at what level? Hard to abate all the way to fossil fuel, yes, no? Explicit reference to Paris Agreement, yes, no? How to draw the line, and the most relevant one is this one: how to draw the line between green and transition, how to use the nuances offered in various ways in regional taxonomies. The publication, yes or no, of a non-exhaustive list of transition projects example, which by essence highlights the room for interpretation on where to draw the line, and thus landing on a minimal list of fossil fuel related projects. I would say that another area of discussion was around recognizing the existing of green instrument that already include some transition eligible categories, and the questioning around how to manage this new instrument versus previous practice and going forward. And last one I would probably mention is how to protect the integrity of green instruments while not reducing drastically its investable or financeable universe. Those were examples of discussion points that were, I would say, highly debated as part of the drafting.
Thank you very much, Orith. Now the scene is set. I suggest to now host our guest speaker for today's expert discussion. So now I'm pleased to host our two guests for today. First, remotely, we have Malika Takhtayeva. You are ESG analyst and sustainable fixed income lead at BNP Paribas Asset Management. Welcome, Malika.
Thank you.
We have on stage Nicolas Pfaff. You are Deputy Chief Executive and Head of Sustainable Finance at ICMA. Welcome, Nicolas.
Thank you, Laurie. Thank you, Orith.
So let's start maybe with you, Nicolas. We mentioned and introduced the ICMA new guidelines. Can you please elaborate on ICMA's journeys when it comes to transition finance and your intention behind this, the publication of these guidelines? Where do you come from? And maybe can you share with us if you have any views on the next step after this publication?
Thank you, Laurie. That's a long question, and I could provide a long answer. I'll try to give you a summary. It's been a long road, and I think this, the debate really started crystallizing about 5 years ago. Okay, so just around COVID, just before then throughout, and the debate was about transition, and it was at first on the question of SLBs, actually. Should we complement a project type approach, use of proceeds type approach with an issuer level instrument? And we all know that we did. We came up with the SLBs. But then, in parallel, of course, there was a early common view among the market participants, executive committee, the principals, our wider stakeholders, that we really needed to talk about transition plans, sustainability plans, et cetera. And this was evidenced by the Climate Transition Finance Handbook. And I think that that was a really seminal document, because it before the discussions that have occurred in the policy sector, but also, I think in fairness, more broadly, in the market, we were ahead of the curve by putting together, guidance, which is very specific, which indicated that really transition needed to be made real by companies with, a handbook leading to plans. Now, having done that, we first had this wonderful spurt of excitement around SLBs. And then rapidly, we realized that, and we collectively, not just us, I think the market, both issuers, underwriters, and investors, was that SLBs were hard to scale. And in fact, they're more complex instruments than we realized, whether it was on the KPIs, whether it was on the performance targets, but also how did we handle situations which have occurred where you don't meet the targets, and what's the market reaction? Is it a positive? Is it a negative? I think there was a realization then that we needed to revisit the project level and the project type approach. And that debate, I think, started primarily from Asia. And we saw not only discussions in the market, but also it was picked up by the official sector, and particularly by Japan. And we had issuances of transition bonds. And in parallel, of course, this came to us. And we then, and this might be a topic we will revisit later, we found that there were differences of use between geographies. I mean, that's not the only differences. So at first, the CTFH 3 years ago, after a difficult compromise, said, well, maybe we can possibly have a regional transition label, but it has to be a green bond, et cetera. It was kind of a complicated message. Now, that didn't stop the Japanese government. It didn't stop a number of issuers in the wider region, and it also didn't stop work on taxonomies, et cetera. And the reason I refer to that is, 3 years later, we realized collectively that we could revisit the idea of a standalone transition bond. Now, then there were all kinds of debates, which we'll come back to. Is it green? Is it not green? Can we? What's the level of the level of specificity that the guidance can have? But as we all know, we actually finally got there. So I won't go into details because we'll be discussing, and Orith already mentioned it. Now, next steps, again, we'll come back to that. But clearly, what we have produced with the climate transition bond guidelines is a 1.0 version. And even though we spent months and weeks, it was a difficult compromise. And what we have is a fairly succinct, high-level document. And we know we're going to have to roll it out by revisiting the project categories. We've clearly identified that there's some things that are clear to us, but not necessarily clear to people who are in all the discussions. So we need an FAQ, and then we may also need case studies. I'll stop there.
Thank you. Malika, one of the hottest topic, as Orith mentioned at the beginning, was the debate around the standalone label versus the subset of green. Nicolas, you mentioned that as well. So really, we're keen to see your views. What was your opinion between these two options? And maybe more broadly, how do you see as an investor, who is particularly invested on sustainable finance market, globally speaking, not on the bond side, but on different type of asset classes? Do you see an interest of this new, let's say, product?
Thank you very much, and thank you very much for having me today. So I was really happy to join the debate at the ICMA, and overall we have been facing the very complex definitional challenges about what the transition and where it is. And Orith correctly pointed out that we have been debating where the transition is basically whether it's at the issuer level or it's at the instrument level. But nevertheless, I think transition finance plays it's an essential role in the global energy investments. And it needs really support and clear guidance in terms of what sort of transition labels we could have and transition, so with the link to the transition projects. So yes, I was indeed quite a vocal a member of the ICMA's discussion, supporting the standalone label, because I was, again, as Orith correctly mentioned, that I was supporting or more really protecting the integrity of green bonds, and trying to emphasize that having a standalone bond standard avoids the confusion of having it as a green sub-label, and allows, for example, banks making transition loans to issue their own transition bonds. So this is really something that I was trying to achieve. So we have a dedicated green bond methodology, and we clearly emphasize what sort of projects that we are happy to finance with our funds that actually have this green focus. So we have 4 dedicated green bond funds with different strategies. And we need to make sure that there is a coherence between the issuer level transition or issuer level ambition with the choice of the projects, and really what we would like to have and keep within those green funds are the green projects, or those that we fully understand the different shades of green. So it's not really black and white, but we need to make sure that it still remains to be green within those green projects. But we still would like to welcome the issues from those hard to abate sectors. And that's why I think the transition bond will actually play a very important role. Especially the role of transition finance really varies by country, and also sector, and changes over time, as we can see. So this is a very important label for the emerging markets countries. So where we have priorities that include cutting methane emissions, so lowering the carbon footprint, also providing infrastructure for low emission gases and helping alongside other technology options. So we just we really need to make sure that there is this system flexibility and electricity security that is provided to those countries, and then also issuers and overall the infrastructure. So we're really happy that there is very good progress, and that's what we have achieved. Thank you.
Jumping on this point of the emerging that you are mentioning, and Nicolas, you mentioned Asia, Orith, you mentioned the fact that it's context-based, which is a specificity of the transition guidance. So maybe on stage, to jump on this point, do you see that some geographies will be more inclined to use this product? Do you see some differences from a country perspective or areas?
Shall I start?
Sure.
Yeah.
The answer is yes, emphatically yes. And you know, it's very clear, you know, sitting in Europe, when you use the term transition, often there is discomfort and sometimes a negative perception because it is seen as inferior to green, and the ambition should be to go to green ASAP, right? And you know, in the European context, and in light of the actual physical and industrial challenges of transition, that position has a lot of merit. The problem is, you know, all geographies, regions, don't have the same history and don't have the same geography and don't have the same constraints or advantages that Europe has. So, you know, if you move to Asia and you look at the prevalence of nation states, of island states, sorry, and then you start thinking about, well, can I move to renewables and at what speed? I mean, just taking that example, you realize that, you know, if you're in Indonesia, having, you know, one grid is a physical impossibility, right? You know, we have this problem. You can have this problem also in Europe. I mean, you look at Greece. I mean, when you've got 2,000 plus islands, you know, you're not going to be able to connect them to one grid. So, you know, I could give many examples of it, but, you know, moving to the Middle East, you know, here are the countries which are, you know, the major producers of fossil fuels. You know, this is an integral part of their economy. You know, the challenge of transition has some pretty, you know, stark, immediate consequences, right? So all this to say, yes, you know, geographies and regions take a different view, and, you know, the perception of transition is very different depending on where you're sitting.
Yeah, I totally second what Nicolas just said. We're both back from Asia, where we were at the ICMA annual conference. Japan, especially, has already started. The sovereign has been issuing their self-labeled climate transition bonds, broadly consistent with what we have just we've just produced, and speaking to industrials and recognizing the very energy challenges of the country, being an island, having issues with the ability to establish renewable energy on its coasts, you know, considering their provision of, I mean, the geopolitics behind their provision of gas, their obvious nuclear history. All of this is making their transition a bouquet of solution. It won't be a one-fits-all solution, and it cannot be a solely renewable solution. So I think it's a very acute example of the region. They're ready to go. They have established a governmental-based strategy called the GX, the Green Transformation Strategy, which is very much into transitioning all aspects of their industrial and electricity sectors. So yes, Asia is definitely, I would say, ready to go and convinced that this is the step ahead in front of them. Middle East, Latin America, probably emerging at large, basically. What I would have to say is also, as you rightly mentioned in your introduction, and as the IEA has established, there's a very acute challenge to make sure we make this a second leg and not a second-tier product, because the need, and that's what I was also trying to rapidly allude to, the need to address the absolute volume of emission is essential, and the biggest volume are lying in this sector. So we need to frame it in a proper way. There are some safeguards in the document relative to lock-in that bear quite a number of challenges, but are looking at geographical specificities, duration of the assets we're looking at, and local context is essential when you want to assess the actual transition dimension of a project.
So Malika, Orith is saying that Asia is ready to go. So interesting maybe to know, are you as an investor ready to invest on your side on these new, let's say, labeled transition instruments? You were mentioning the green bond strategy that you already have. So will they fit into the existing strategy? Do you anticipate that you will need to adapt your existing investment strategy and anticipate you and your peers maybe? How do you see the investment side, I mean, in terms of readiness to invest in these new instruments?
Yes, thank you very much, Laurie. So for us, really, it's all about the impact. We need to understand how activities contribute meaningfully to short or long-term decarbonization targets. And also the issues should really demonstrate tangible GHG emission reduction benefits. So whether it can be quantified or it's really qualitatively justified. So basically it needs to be a part of a broad strategy to reduce the emissions over time. And really what we are happy to see is that these issues will be able to produce regular impact reporting. So, and then also provide the ability to finance elements such as, for example, decommissioning, and which we strongly believe that shouldn't be part of green bonds, but we still should support them because they're part of the decarbonization pathways for some companies. So yes, indeed, we still need to do a lot of work and understand how these will go forward in terms of whether we'll be part of the dedicated funds or subject to further, of course, analysis to assess this investment universe or through inclusion in existing funds. We cannot tell for sure, but we really need to see the progression, and this has already been quite a strong step forward. We do have already a transition stream in our equity infrastructure strategies. So basically the LMA's guidance is really helpful from this perspective. And overall, this is something that is really important because it's part of the quantitative, as I mentioned, and qualitative assessments of the transition plans, and then also timeframes, the CapEx plans, and the overall governance. We use the EU taxonomy aligned turnovers or EU taxonomy eligible turnovers. So it's basically, this has already been part of some of those funds that we have launched. And I think we have a lot more work to do going forward, especially with the changes and updates of the SFDR 2.0.
Yeah, we've seen this evolution. So the EU Commission recently published the draft proposal for the evolution of FCDR. You were mentioning that. So it's pretty consistent with the emergence of the transition category, which is the new one. So good to see, and this is what you mentioned. Any maybe complementary reaction on this side, Nicolas, with the update of SFDR?
Yes. I mean, this is... it's a draft, right? I mean, there's still a lot of work that's going to have to go on through the co-legislative process. And for those that don't know, the Commission proposes a text, and then the member states and then the Parliament have their say. So the initial text can change quite a lot. But anyway, with the current draft, we have a proposal for so-called Article 7, which is referred to as the transition category. Let's give the Commission its due. I mean, this is welcome. I mean, this is a significant change in their thinking. Before, it was really focused on taxonomy alignment, which tended to equal green now or green in the very short run. Again, it's not as simple as that, but nonetheless, for the Commission to turn around and say there is such a thing as transition, and we get it, and sort of the two pillars which Orith is talking about. Now, in practice, again, we'll have to see how the text evolves. One of my concerns is there's a tendency in of the European legislators to always fall back to issuer-level exclusions. These typically refer to fossil fuel sectors, and so there's a risk that the final text exclusions will come back in, and then that will, I think, seriously narrow the opportunity that this fund category creates. Now, the second thing, word of caution, you can impose fund categories, and supposedly these are retail-facing. And it's one thing we haven't talked about because we tend to be wholesale, all of us, and the sustainable bond market is wholesale. But if you're talking to retail investors, again, telling them that transition is okay rather than green is a very tall order. The perception in the public is, more often than not, I want to invest in something which, is green, is doing good. And if you say to me, well, actually, you're doing this thing and it's transition, it's a much more complicated sell. So again, great development, but, let's be cautious in terms of what we'll end up with. And in the meanwhile, let's just keep on doing what we're doing.
Can I please ask each of you one core challenge that you think will be just to see the emergence or the development of this new market segment in terms of, applicability? We've seen the safeguards. In terms of integrity, in terms of articulation between existing green and this new transition segment. Can you please try to select one core challenge from your point of view? Let's start maybe with you, Malika.
I think the biggest challenge will be for us to see how markets react to this new label. And overall, I know that it's actually a very positive consistency between the loan market and the bond market, but the reputational risk and then how it's been perceived as greenwashing will still remain. And we just need to make sure that we still see the supports of the issues that from the hard-to-abate sectors that issue this new label, transition-related labels.
Stage.
Okay, thank you. I would say one of the key challenges is the safeguards, and did we get the safeguards right? We struggled with that. We've been quite flexible. It's close to a comply and explain approach. We phrased it a little bit differently. It's are you meeting them, or will you be able to meet them at a later date? So we've tried to introduce flexibility, but nonetheless, the safeguards quite a high bar, and legitimately so. And I would single within that we have said that you need to have some kind of overarching sustainable transition plan. I think again that makes complete sense, but we know that is a high bar for a lot of companies in the hard-to-abate sector. It's difficult, particularly in the current context, to make that kind of overarching commitment. So let's see.
It's the balance between integrity and applicability.
Yeah.
I'm going to cheat and do 1.5 challenge.
Which I did too.
Just building on the topic of the safeguards, I have to confess we've been quite instrumental in pushing for the carbon lock-in topic to be integrated. Carbon lock-in is a difficult thing to assess. We do not have a one and only framework to assess it. It's incredibly context specific, be it sector or technology or even regional, requires a deep understanding of transition pathways, be them sectorial or local. And we will find ourselves in all sorts of situations where, from a pragmatic perspective, a fuel switch or a certain specific situation will be highly impactful from a greenhouse gas emission reduction, but we will be facing carbon lock-in. And I think that's where one of the core challenges is going to lie, and it fits with also the notion of how do you articulate the various definitions of green and transition. To me, those are the two main, the two faces of the same coin of the applicability. Making sure we got the safeguards right, we are at the right level of enforcement, and we still remaining pragmatic.
Maybe one last question. Let's try to be relatively short, but I would be really keen to see your, let's say, views on more prospective view on what could be the main, let's say, areas of development in terms of concretely which type of projects you will see, you will expect to see. We've seen that a list of eligible categories has been drafted in the ICMA guidelines, but do you already have a non-exhaustive one? So do you have some views on that? How we can help channeling the decarbonization, actually? We really mentioned hard to abate. So what concretely we can expect in terms of underlying investment?
Why don't you start?
Once we overcame the fear of the reputational fear that I'm sure we are going to see and discuss with our clients, I believe that fuel switch phase out are probably the first obvious categories that we would be running after. They are not addressed by the green instruments, and they have such an instrumental impact that at least we should make sure we channel capital to support those type of assets.
Maybe Malika on your side?
Well, I think we've we all actually elaborated a lot about the types of projects. I think this will be a non-exhaustive list, and we will definitely see different types of projects, especially from issues from emerging markets, because this is a very specific sectors and geographical areas. But I think the focus needs to be on science-based targets and the transparency. So hopefully we will see this transparency through the strong metrics that will be provided. And I think one of the most important in our view is the carbon footprint, the metric that will be able to support the significance of these labels, because at the end of the day, investors need to demonstrate by supporting these projects the way how we decarbonize our funds. And the carbon footprint of these projects will be able to provide this credibility to even the sectors that come from the hard to abate areas and those that are high emitting sectors. But if the issuers are going to be able to provide this very strong support and the information and the data, investors will really be able to also willing to join this sustainable finance market and allocate their capital and include them in their relevant strategies.
That's what for you.
I'm always very cautious because I'm not in the market, right? But we've also, to complement perhaps what Orith is saying, is we've heard a lot about methane abatement. Very challenging topic. Will that result in bonds in that area? We've accommodated that after much debate. So that's just one that has come up recurrently. But I have less of a feel than those of you who are in the market. And I would just refer back to the ambition. I mean, clearly, what we want is that this label is used and that it channels new money into these areas, and that we sort of collectively get off the fence and accept that this is an area which is legitimate. It's it may not be as easy intellectually and perhaps even emotionally than green, but we have to get our hands dirty, and we have to go and make these investments with all the caveats, the safeguards, etc., and see significant funding, because this is a gap.
Thank you, and thank you to the three of you. Thank you, Malika, for joining as well. Thank you to you for your audience, and stay tuned. Our next session is now scheduled for January next year, and all the replays are available on our YouTube channel. Have a nice day.